Credit is one of the essential components of the financial industry. Understanding the different kinds of credit is important for individuals and businesses that seek to borrow or extend credit, as well as to make informed decisions and manage their finances effectively. Good day, everyone. My name is Jennifer Tibay, and we are the Group 4. Today, we are going to discuss the different kinds of credit, their importance, advantages, and disadvantages, also their key differences and how they are used in practical scenarios. Before we begin, let me introduce you my fellow members. Ms. Neren Bernardes, Ms. Fedelino Jeremy, Ms. Ellen Legaspi, Ms. Renji Mateo, Ms. Giselle Monteroso, and Ms. Stella Maris Ramirez. Consumer credit is a type of credit that allow individual to borrow money to finance purchases or pay for services, which is usually repaid over time with interest. The advantage of consumer credit allows individual to make large purchases without having to pay upfront or down payment. It helps build credit history and it will offer flexibility in payment options. The disadvantage of consumer credit, such as high interest rate, can lead to debt if not managed properly, can damage credit score if payments are missed or made late. There are several companies and businesses that offer consumer credit to individuals in need. Let's take a closer look at some of the examples. First is banks. Banks are some of the most common sources of consumer credit, such as BDO, BPI, and Metrobank, that will offer personal loans which can be used to finance various expenses such as home renovation, travel, or education. Second is credit card. Credit card companies also offer consumer credit in the form of credit cards. Companies such as Citibank, HSBC, and Metrobank offer credit cards that allow individuals to make purchases and pay for them over time, usually with interest. Third is online lending platforms are becoming more popular as a source of consumer credit. This platform offer loans that can be applied for and processed entirely online. Some example of online lending platforms include Tala, Kasyalo, and Loan Ranger. Fourth is retail stores such as SM, Robinsons, and Rustans also offer consumer credit in the form of in-store financing or credit cards. This option allow customer to make purchase and pay for them over time, often with special promotion and discounts. These are just a few examples of the companies and businesses that offer consumer credit. It's important to note that each company may have different requirements, interest rates, and repayment terms. So individuals should do their research and choose the option that best suits their needs and financial situation. Consumer credit is a type of loan that individuals can avail of to finance their personal expenses. However, not everyone is eligible for consumer credit. There are certain requirements that individual must meet before they can avail of this type of loan. First, a good credit score. A good credit score is essential for availing consumer credit. A credit score is a numerical representation of an individual creditworthiness and indicates that an individual is capable of paying back the loan on time. Next is proof of income. This can be in the form of payslip, income tax returns, or bank statement. Proof of income ensures that the individual has the financial means to pay back the loan. Third is individual must provide a valid government-issued ID to avail consumer credit. This ensures that the individual is who they claim to be and helps prevent identity theft. Fourth, individual must provide proof of their billing or residence to avail consumer credit. This can be in the form of utility bills or other similar documents to ensure that the individual has a stable living situation and is less likely to default on the loan. Fifth is depending on the type of credit. Individuals may be required to provide some form of collateral or cosigner. Collateral is an asset that an individual pledge as a security for the loan, while a cosigner is someone who agrees to pay back the loan if the individual defaults. And last, depending on the lender, individuals may be required to provide other financial documents, such as credit score or debt-to-income ratio. These are the requirements that individual must meet to avail consumer credit. By meeting these requirements, individual can improve their chances of being approved for a consumer loan and successfully finance their personal expenses. Next is mercantile credit. Mercantile credit, on the other hand, is credit extended to business for commercial purposes. This type of credit is used to finance the purchase of goods and services needed for business operation. The advantages of mercantile credit allow businesses to purchase inventory or services without having to pay upfront, helps improve cash flow, and establish relationship with suppliers. While the disadvantage is late payments can damage the relationship with suppliers, can lead to debt if not managed properly, and can impact credit score if payments are missed or made late. Mercantile credit, also known as commercial credit, is a type of credit that businesses can avail or to finance their operation, such as purchasing inventory, funding expansion plans, and paying suppliers. Let's take a closer look at the companies that offer mercantile credit and the requirements to avail it. First is banks are also offered and most common sources of mercantile credit. These banks offer various types of loans, such as business loans and credit lines, that can be used to finance a business operation. Next is financing companies, such as Asia Link and Radio Wealth, also offer mercantile credit to businesses. These companies offer loans and credit lines with different repayment terms and interest rates, depending on the business financial situation. Third is some suppliers or distributors such as Unilever and Coca-Cola offer mercantile credit to their clients. This option allows businesses to purchase products or services and pay for them at a later date, usually with interest. And fourth, factoring companies such as Regent Pacific Group and 1/8 Flowers offer mercantile credit in the form of factor. Factoring is a type of financing where a company sells its account receivable to a factoring company at a discount in exchange for immediate cash. I also prepared an example scenario for additional information about the two topics that I already discussed. Miss Lalaine is a small business owner who has been running her retail store for 5 years. Despite having a loyal customer base, she is facing cash flow issues and need to purchase 30,000 worth of inventory to stock her store for the upcoming holiday season. However, she doesn't have enough cash on hand to make the purchase. For the option 1, which is consumer credit, Miss Lalaine decided to apply for a credit card with a 0% interest promotional offer for the first 12 months. She was approved for a credit limit of 50,000 pesos, which was enough to cover the cost of the inventory she needed. However, Lalaine had to make sure that she paid off the balance before the promotional offer ended to avoid accruing interest charges. Miss Lalaine was able to use the credit card to purchase the inventory and work hard to sell enough inventory to pay off the balance on the credit card. For the next option, which is mercantile credit, um, Miss Lalaine also considered reaching out to one of her suppliers for mercantile credit. and one of her suppliers offered her a 50,000 pesos line of credit with a 10% interest rate. Lalaine could purchase the inventory she needed and pay back the supplier over time, usually within 30 to 90 days. This option allowed Lalaine to pay for the inventory after she sold it to her customer, which improved her cash flow. In conclusion, Lalaine was able to address her cash flow issue by considering two options, which is consumer credit and mercantile credit. The first option, the consumer credit, allowed Lalaine to use a credit card to purchase the inventory she needed, but required her to pay off the balance before the promotional offer ended. And the second option, mercantile credit, allowed Lalaine to pay for the inventory after she sold it to their customer, which improved her cash flow. And Lalaine was able to make a decision based on her business needs and financial situation. And this is the end of my topics, and the next presenter will discuss revolving credit and investment credit.
Hey everyone, I am Andrew Diligaspi and in this part of our presentation, we will tackle about the revolving and investment credit including their definition, example, advantages and disadvantages, and more. So in this first slide is the revolving credit. What does it really mean when we talk about this kind of credit? This is actually defined as a credit line that remains available even as you pay the balance, wherein the borrowers can access credit up to a certain amount and then have an ongoing access to that amount of credit. They can repay the balance in full or make regular payments. Each payment minus the interest and fees charged opens the credit again to the account holder. Experts generally recommend borrowing or using less than 30% of your credit limit. As you keep paying off your revolving balance, your credit score will go back up as you pay up more of your available credit. Next is what are the examples of this revolving credit? Common examples of revolving credit includes credit cards, home equity lines of credit or HELOCs, and personal and business line of credit. Among these three, credit cards are the best known type of revolving credit, wherein the cardholder routinely makes charges, pays them off whether in full or partially, makes more charges, and so on. The amount of the money the borrower uses within their credit limit is up to them, and there is no set monthly payment plan. The borrower has the option to pay their balance off in full each month, or they can pay just the minimum and carry or revolve their balance to the next month, which usually means accruing interest. So, how does the revolving credit work? Revolving credit is generally approved with no date of expiration. The bank will allow the agreement to continue as long as the account remains in good standing. Over time, the bank may raise the credit limit to encourage its most dependable customers to spend more. Borrowers pay interest monthly on the current balance owed. Because of the convenience and flexibility of revolving credit, a higher interest rate typically is charged on it compared to traditional installment loans. Revolving credit can come with variable interest rates that may be adjusted. This kind of credit has its own advantages and disadvantages. As you probably know, a revolving line of credit is a type of loan that allows you to borrow money up to a certain limit. This credit has its advantages, such as funds are available as you need them, and you only pay interest on the amount that you actually borrow. This can be an attractive option for small businesses or individuals who needs access to cash but don't want to pay the high interest rates associated with other types of loans, such as credit cards. However, there are also some potential downsides to consider before you take out a revolving line of credit. Although the interest rates on a revolving line of credit are usually lower than those on the other types of loans, they are still higher than the rates you would get if you paid cash. This means that you will end up paying more money in the long run if you use this type of loan. And another downside of a revolving line of credit is that you may have a lower credit limit than you would be with other types of loans. This can be a problem if you need to borrow a large amount of money or if you have a high interest rate. And we will now proceed to the next kind of credit, which is the investment credit. So, what is the definition of this kind of credit? Investment credit is defined as a type of medium or long term loan with a term of 2 to 20 years. You can use it for purchasing fixed assets, such as property for your business, company cars, and equipment. It can be used to fund the startup of your business or for new investments to further grow your business. In general, though, they are used as an incentive to encourage companies to spend money upfront on investments that may not pay off immediately. Business must generate a profit to remain viable in most cases, which can make big investments seem too risky. The soundness of an investment contract depends mainly upon the continuous and repeatable operation of the borrowing enterprise. Investment credit is evidenced by negotiable bonds or long-term notes. Still, in some instances, they may also be evidenced by real estate mortgage. The examples of this investment credit are long-term loans, bonds, or debentures. In this kind of credit, five major sources are available from which funds for long-term investment may be secured, such as funds of individual investors, trustees of funds of individuals and estates, insurance companies, banking institutions, and business concerns. So the next one is, what's the importance of this credit? Investment credit is important because it usually works to lessen the company's overall tax burden.
Good day everyone. Today we'll be talking about merchandise credit, a type of credit that can be used to purchase goods or services from a particular retailer or business. This credit can come in many forms, such as gift cards, vouchers, or store credits. In this presentation, we'll explore the benefits of merchandise credit, how it differs from other types of credit, and best practices for businesses that want to implement a merchandise credit program. Merchandise credit is a form of payment that can be used to purchase products at a particular store or chain. It is similar to gift cards and store credit, but typically has specific terms and conditions that govern its use, and is often issued as a refund or exchange for products that were previously purchased but returned or exchanged. It can also be given as a form of compensation or goodwill gesture from the retailer. Merchandise credit is typically non-transferable and can only be used at the issuing retailer. Merchandise credit, gift cards, and store credit are all forms of specific credits, but they have some key differences. Merchandise credit is typically issued in situations where a customer returns an item without a receipt and wants to exchange it for something else in the store. Gift cards, on the other hand, are often purchased by customers as a gift for others. Store credit is similar to merchandise credit, but it is usually issued in situations where a customer returns an item with a receipt and wants to receive a credit that can be used toward a future purchase at the same retailer. It's important for both retailers and customers to understand the differences between these types of credits in order to use them effectively between retailers, so it's important for customer to read the details carefully before using them. In short, merchandise credit can offer several advantages over traditional refunds. First, it can reduce costs associated with processing returns and restocking returns items. Second, it can help to improve inventory management by providing an alternative to restocking return items. Plus, it can increase customer loyalty by offering flexibility and convenience to customers. And it creates opportunities for upselling and cross-selling additional products, which can further increase the store revenue and profitability. Overall, merchandise credit can be a win-win solution for both retailers and customers. Merchandise credit can be issued in different ways, such as through a physical card, email, or digital voucher. It can be used for full or partial payments, and it can also have an expiration date. When redeeming merchandise credit, customer must present the credit to the retailer or business. The credit is the subtracted from the total purchase price and the customer pays the difference, if any. In summary, merchandise credit is a flexible and convenient form of payment that can be earned by customers through a variety of means. It offers an alternative to traditional refunds and can be used to purchase products from the store or chain where it was earned. Merchandise credit is a flexible and convenient form of payment that can be used to improve customer loyalty and increase sales. It is typically issued in the form of a physical card or voucher and may be applied directly to the customer's account. When making a purchase, the customer presents the merchandise, credit card, or voucher to the cashier, and the cashier applies the value of the merchandise credit to the purchase. Merchandise credit may have specific restrictions such as expiration date, or it may be limited to certain types of products. It is important to understand any restriction or expiration dates that may apply to the credit. Clear terms and conditions for merchandise credit are important because they help to promote transparency, prevent misunderstanding, ensure consistency, comply with legal requirements, and maintain positive relationship between retailers and customers. By clearly outlining how merchandise credit works and what options customers have, retailers can build trust and prevent disputes that can damage their reputation and cost them time and money. Additionally, clear terms and conditions help retailers to meet legal obligations and avoid legal disputes, ensuring that all customers are treated fairly and consistently. Clearly communicate the terms and conditions of merchandise credit, including any restriction or expiration dates, on the merchandise credit card or voucher and on the retailer's website. Train staff to accurately explain the terms and conditions of merchandise credit to customers. Update the terms and conditions regularly to reflect changes in policies or legal requirements. Ensure that the terms and conditions are easily accessible to customers and provide contact information for customer service in case of questions or disputes. Clear terms and conditions for merchandise credit are essential to provide a positive shopping experience for customers and avoid any potential disputes that may arise from misunderstanding or lack of clarity. Overall, successful merchandise credit programs provide customers with incentives to shop and return to the retailer, which can help build customer loyalty and increase sales. By offering merchandise credit, retailers can provide a flexible and convenient form of payment that can improve the overall shopping experience for customers. Merchandise credit programs have helped these businesses grow and retain their customer base by providing incentives for frequent purchases and building customers' loyalty. By offering merchandise credit, these businesses have made it easy for customers to shop with confidence and incentivize them to return for future purchases. It is important to balance the benefits of merchandise credit with potential costs and risks. Retailers must evaluate the impact on cost of goods, additional administrative costs, potential fraud, and impact on customer experience before implementing a merchandise credit program. The ins and outs of borrowing money. In today's world, borrowing money has become a necessity for many people. Whether you need to finance your college education, purchase a home, or start a business, borrowing can be a helpful tool in achieving your financial goals. However, it's important to remember that borrowing comes with risks and costs that need to be carefully considered. In this presentation, we will be exploring the different types of borrowing, the benefits and drawbacks of each, how to choose the right option, and the best practices for managing them. There are different ways to borrow money, such as using credit cards, take it out personal loans, getting a mortgage, auto loan, or student loan. Each type of borrowing has its own advantages and disadvantages, and it's important to carefully consider which one is the best suited for your needs and financial situation. Certainly, here's a brief explanation of the benefits of borrowing. First, allows for major purchases and investments. Borrowing money can help you make big purchases or investment that you may not be able to afford otherwise, such as buying a house or starting a business. By borrowing, you can spread out the cost of these expenses over time and make them more manageable. Second, provides financial flexibility. Borrowing can also provide you with financial flexibility. For example, if you need to make a large purchase but don't have the cash on hand, borrowing can allow you to make the purchase and then repay the debt over time. This can help you to avoid having to dip into your savings or emergency fund and builds credit history. When you borrow money and repay it on time, you can build a positive credit history. This can help you qualify for lower interest rates and better loan terms in the future, making it easier and less expensive to borrow money when you need it. Overall, borrowing can be a useful tool for managing your finances, as long as you use it responsibly and make you sure you can afford to repay the debt. While there are certainly benefits to borrowing, there are also drawbacks to consider. The main drawbacks of borrowing include interest and fees that add to the overall cost of the loan. There is also the risk of default, which can damage your credit score and make it difficult to borrow in the future. Lastly, there is the potential for a debt trap, where borrowers may end up borrowing more than they can afford to repay, leading to financial difficulty. Choosing the right borrowing option is critical to achieving your financial goals while minimizing risk and costs. To choose the right option, it's important to evaluate your needs and goals. Compare Compare interest rates and fees. Consider repayment terms and schedule, and read the fine print of the loan agreement. The best practices for managing debt. Creating a budget is crucial for staying on top of payments and avoiding unnecessary borrowing. Avoiding high interest loans can also help to minimize the overall cost of borrowing. Staying current on payment is important for maintaining a good credit score and avoiding default. And lastly, seeking professional help such as a financial advisor or credit counselor can be helpful for those struggling with debt.
Good morning, Professor Victoria Bagtas and classmates. I'm here to discuss about agricultural credit. As you know, agriculture is a vital sector of the economy, and access to credit is essential for farmers to sustain and grow their businesses. Today, we will discuss the definition, types, sources, advantages, disadvantages, and examples of agricultural credit. What is agricultural credit? Agricultural credit is form of financing that is especially designed for farmers, ranchers, and other agricultural producers. The purpose of agricultural credit is to provide these producers with the necessary capital to operate their businesses, purchase inputs such as seeds and fertilizers, buy machineries and equipment, and manage their cash flow. There are three main types of agricultural credit: short-term, medium-term, and long-term. Short-term credit is used to finance seasonal inputs such as seeds and fertilizers and is usually repaid within a year. Medium Medium-term credit is used to finance capital expenses such as machinery and equipment and is usually repaid within 3 to 5 years. Long-term credit is used to finance land purchases and is usually repaid over a period of 10 to 20 years. Now, where can agricultural producers obtain credit? There are several sources of agricultural credit, including government agencies, commercial banks, cooperative, and microfinance institutions. Government agencies such as the Department of Agriculture provide direct loans and loans guarantees to farmers. Commercial banks offer agricultural loans to qualified borrowers and may also provide other financial services such as crop insurance. Cooperative are member-owned organizations that provide credit and other services to their members. And microfinance institutions are nonprofit organizations that provide small loans to farmers and other entrepreneurs who lack access to traditional sources of credit. What are the advantages of agricultural credit? First, agricultural credits provide access to capital that would otherwise be unavailable to many farmers. Second, agricultural credit is often more flexible than other types of credit, allowing farmers to borrow money when they need it and repay it when they have cash flow. Third, agricultural credit can contribute to rural development and food security. And what are the disadvantages of agricultural credit? First, agricultural credit can come with high interest rates, which can make it more expensive for farmers to borrow money. Second, farmers may become overly dependent on credit and may have difficulty repaying their loans if their crops fail or prices fall. Third, agricultural credits may be limited to certain types of farmers or regions, which can make it difficult for some farmers to obtain credit. And last, agricultural credit can have environmental impact if it is encourages and sustainable farming practices. There are examples of agricultural credit. In the Philippines, agricultural credit is crucial for farmers to sustain their livelihood and contribute to the growth of the agricultural sector. The government and financial institutions provide various forms of agricultural credit, including crop loans, livestock loans, and farm equipment loans. Crop loans are essential for farmers to purchase seeds, fertilizers, and other inputs necessary for crop production. These loans are usually short-term and have lower interest rates than other forms of credit. Livestock loans, on the other hand, are used to finance the purchase of animals such as cows, pigs, and chickens. These loans help farmers improve their livestock production and increase their income. Farm equipment loans provide funding for the purchase of machinery and other equipment necessary for farming operations. These loans enable farmers to improve their efficiency and productivity, leading to higher profits. Example of farm equipment that can be financed through loans include tractors, irrigation systems, and harvesting equipment. Overall, agricultural credit plays a significant role in the agricultural sector in the Philippines. Through various forms of credit, farmers can access the capital they need to sustain and grow their businesses, leading to rural development and food security. I will also discuss what commodity loans are, how they work, the different types of commodity loans, and their advantages, the conclusion, and the example of commodity loans. What are commodity loans and why are they important? Commodity loans are loans that are secured by the borrower's commodity inventory. They are typically used by farmers or other agricultural producers to finance the production of their crops or livestock. Commodity loans are important because they provide a reliable source of financing for farmers and other agricultural producers, which can they help them to grow their businesses and increase their productivity. How commodity loans work? Commodity loans work by allowing the borrower to use their inventory of commodities as collateral for the loan. The lender will typically provide a loan amount based on the value of borrower's inventory, which can include crops, livestock, or other agricultural products. The borrower can use the loan proceed finance their production activities. What are the different types of commodity loans? There are several different types of commodity loans, including crop loans. These loans are used to finance the production of crops and are secured by the borrower crops inventory. Livestock loans. These loans are used to finance the production of livestock and secured by the borrower's livestock inventory. Warehouse receipt loans. These loans are secured by the borrower's warehouse receipts, which provide proof of ownership of stored commodities. Marketing loans. These loans are used to finance the marketing of commodities and are typically backed by government programs. There are several advantages to using commodity loans, including access to financing. Commodity loans provide reliable sources of financing for farmers and other agricultural producers. Risk management. Commodity loans can be a good way to manage risk as they allow farmers to lock in prices for their crops or livestock. Support for local economies. Commodity loans can help to support local economies by providing funding for small businesses and rural communities rather. What are the disadvantages of commodity loans? Uh, there are also some disadvantages to using commodity loans, including price fluctuations. Commodity prices can be volatile, which can create uncertainty for borrowers. Weather-related risk, natural disaster, and extreme weather events can damage or destroy crops or livestock, which can impact the value of the borrower's collateral. Risk of default. If the borrower is unable to repay the loan, the lender may seize the borrower's inventory, which can have a significant impact of the borrower's businesses. Some examples of commodity loans available here in the Philippines include Land Bank of the Philippines Agrarian Production Credit Program, APCP rather. This program provides crop loans to small farmers and fisher folk to finance the production of rice, corn, high-value crops, and fisheries. Agricultural Credit Policy Council Production Loans Easy Access. This program provides crop and livestock loans to small farmers and fisherfolk. Department of Agriculture's Agricultural Competitiveness Enhancement Fund. This program provides marketing loans to farmers and fisherfolk to finance the promotion, marketing, and distribution of their products. In conclusion, commodity loans are an important sources of financing for farmers and other agricultural producers. They allow borrowers to use their commodity inventory as collateral for a loan, which can help them to grow their businesses and increase their productivity. However, there are also some disadvantages to using commodity loans, including price fluctuations, weather-related risk, and the risk of default. And overall, commodity loans can be a valuable tool for farmers and other agricultural producers, but it's important to carefully consider the risks and benefits before taking out of a loan. Thank you for listening to my presentation.
Good morning. I am Jacel Monteroso and I'm here to discuss export and industrial credit. So let's talk about export credit first. So the Organization for Economic Cooperation and Development notes that export credit is an insurance guarantee or financing agreement which enable a foreign buyer of exported goods and or services to defer payment over a period of time. So from the term itself, export means that it has something to do with international market. And credit is a kind of financing. Therefore, it helps the finance the sale of goods and services to international markets. And in addition, both private banks and government agencies can provide export credits. And government export credit agencies are frequently willing to assume credit and country risk that private institution cannot or will not. So, halimbawa, exported ako ng mga products from Japan and syempre to purchase, kailangan may exporter galing doon. So, kapag nakukuha ko na ang product, pwede na hindi ko siya bayaran agad. Pero, papayag ba si exporter nun? Siguro, pwedeng oo, pwedeng hindi. So, kaya naman pwede na hindi ko siya bayaran agad is dahil may third party na magbabayad para sa akin. And this third party is agency called Export Credit Agency na same country kung saan naroon si exporter. So, babayaran niya si exporter and at the end of the day, ang babayaran ko na ay si agency. So, si agency at ako as a purchaser, magkakaroon ng agreement. So, okay, ganito, babayaran niya ang utang ko, tapos babayaran ko naman siya. So, export credits are generally divided into short-term, medium-term, usually 2 to 5 years repayment, and long-term, usually over 5 years. Export credit agencies provided these financial services to companies that do business abroad, particularly for business activities in Global South. Example of export credits are the loans granted to the industries to finance the acquisition of equipment and machineries. ECAE are collectively among the largest sources of public financial support for foreign corporate involvement in industrial projects in the Global South. For example, ECAEs are estimated to support twice the amount of oil, gas, and mining projects as to all multilateral development banks such as World Bank Group. They are thus extremely important sources of finance and insurance for the private sector. According to OECD data in 2015 alone, ECAs in OECD member nation provided $125 billion in credit insurance guarantees and interest support. ECA Watch has noted that as projects funded by ECA are highly
Risks due to their environmental, political, social, and cultural impacts most would not come to life without the support of financial banking of ECAs. Of course, there are many advantages and disadvantages of export credit agencies. Advantages. Number one, ECA encourage exporters to trade confidently despite the risks and other uncertainties. Number two, ECA facilitates importers to purchase by extending credit facilities. Number three, it contributes to both balance of trade and the balance of payment. Number four, ECAs bring much needed foreign exchange into a country. Number five, it increases the GDP of an economy. Disadvantages. Number one, an ECAs can lead to increased financial burden and international debt. Number two, ECAs ensures client against political risk and involving unethical causes.
Industrial credit. Industrial credit is intended for financing the needs of industries like logging, fishing, manufacturing, and which involves large amount of money. So therefore, this loan made available to business in order to cover the costs associated with the purchase of machineries and tools used in the production such as fisheries, as well as the cost of raw materials used in the production of finished goods. So, itong type of financing is pandagdag sa kapital or puhunan ng mga business to help them operate well and grow. Kaya rin siguro pinayagan ng Development Bank of the Philippines ang type of credit na ito, and it is a long term pala. So, what are the advantages and disadvantages of industrial credit? So, advantage. Industrial credit can help businesses finance their operation and expand their production capabilities. It may also be more affordable than other forms of financing such as equity financing. So, ayun nga, more puhunan or capital, mas malaki ang possibilities to produce a product to be sold and to earn more, lalo na kung yung business mo pala in demand ngayon. So, the disadvantage is that industrial credit may require collateral and may come up with a high interest rate. Additionally, if the business is unable to pay back the loan, then they may risk losing their asset. So, diba kapag nagpapautang ay mayroon mga kinoconsider mga requirements kasi hindi basta-basta ang pagpapautang ngayon. Kailangan nila ng assurance or collateral in case na mag-suffer ng financial loss ang isang business. So, ayun ang risk sa credit or loan. Kailangan mo ipagsapalaran ang asset mo.
Hello, good days everyone. I am Renji Mateo. So for today's, I'm going to discuss what is commercial and industrial credits. So what is commercial and industrial credits? It is a loan made to a business or corporation. Commercial and industrial loans provide companies with the funds that can be used for a various purposes, including working capital or to finance capital expenditure such as purchasing machineries. Typically, commercial and industrial credits or loans are short-term loans with a variable interest backed by the collateral. Commercial and industrial loans are different from commercial real estate loans, or we call CER, which are mortgage loans used for a commercial property purposes. And also how commercial and industrial loans work. Commercial and industrial loans usually have a variable rates of interest that are tied to the bank prime rate or another benchmark rates. Although a large corporation may take out commercial and industrial loans, they also have to access the financial markets or funding by issuing bonds or equity shares. However, many small and medium-sized businesses do not have access to issuing stock shares since they may not be traded on a stock exchange. As a result, these small and mid-sized companies use commercial and industrial loans to fund their cash flow and expenditures needs. Commercial and industrial loans are different from commercial real estate loans, which is more than loans used for commercial property purposes, including office and hotels. Also, commercial and industrial loans are not the same as a consumer loans, since only business can get commercial and industrial loans. That is the pros and cons or advantage and disadvantage of commercial industrial credits. Commercial and industrial credits allow the business to bypass the typically long and arduous process of drumming up equity investor. Not only it's more costly and time-consuming to obtain equity investor, but being a publicly traded company means being accountable to those investors and adhering to additional regulation from the U.S. Security and Exchange Commissions. With the necessary collateral, commercial and industrial loans can help companies raise funds needed for expansion. However, commercial and industrial loans need to be paid off and in some cases within a few years. Also, if the interest rate high, the debt serving costs can hinder up companies' cash flow, taking away from the business working capital. How businesses use commercial and industrial credits can be used at any time in a lifetime of a businesses when it needs generate a cash. For example, a startup may take out commercial and industrial loans to get up and running because the outlay of cash of onset can be greater than the revenue generated from sales. The loan can be paid down as a company generate revenue. Commercial and industrial loans are also useful to help businesses fund the purchase of capital property like machineries and equipment. They can be used to purchase the renovate new facilities, buy inventory, furniture, retail stores, or a set up production lane. The funds can also be used to join a competitor or suppliers in a joint revenue.
Good day everyone. My name is Jeremy Padilino. I will discuss about real estate of credit. An effective resources for a business that expanding quickly is a real estate line of credit for investors. A line of credit typically allows for numerous draws, so you can use it for various projects. Users only pay interest on the amount they draw, unlike with a traditional loan, and costs are typically far cheaper than they would be with a hard money lender. A real estate line of credit can give you access to flexible funding, which makes it a desirable financing choice for real estate investor. With expanding businesses for both real estate investor and homeowners, a business line of credit can be a crucial component of both short and long-term business finance plans. And that's all. Thank you.
Understanding the different types of credit is important for individual and businesses alike. Whether you need credit for personal, industrial, or commercial purposes, to finance real estate or for investment, regardless of the type of credit you choose. It's important to manage your credit responsibly. This includes making payments on time, monitoring your credit score, and avoiding excessive debt. Seek professional advice if needed. If you're unsure about which type of credit is right for you, it may be helpful to seek the advice of a financial professional. They can help you evaluate your option and make an informed decision based on your specific circumstances. Again, this is Jennifer Tibay, and this is the end of our topic, and we are hoping that you will learn something from us. Thank you and have a great day.